Ladies and gentlemen, good morning, and thank you for attending today's webinar. My name is Sharak Shahabi-Azad, Director of Research at the Global Risk Institute. And on behalf of GRI, I am pleased to welcome you to the second event in our 2026 Macroeconomic Policy webinar series titled Canada's Productivity Challenge and the Fiscal Path to Recovery. If you were unable to join us for the first webinar in the series with Chris Reagan and Warren Lovely, it is now available on our website. Our speakers made a compelling case that Canada's fiscal position looks stronger on paper than it is, and that sustained borrowing is quietly rebuilding fiscal risk at a level not seen since the 90s. Today's webinar is a nice extension from that discussion. As a reminder, the session is being recorded and it will be available on the GRI website in a few days. Your microphones are muted to avoid background noise. If you have a question for our presenter, please submit it through Slido. And on the off chance Slido isn't accessible, I will also monitor the WebEx chat, so feel free to submit your questions there. And finally, you'll be prompted to fill out our event survey near the end of the webinar. It is very short, just star ratings, no comments needed, but your feedback is very important to us. So with that, let's get started. Today, we're excited to welcome back Trevor Toome, Professor of Economics and Director of Fiscal and Economic Policy at the University of Calgary's School of Public Policy. Trevor served on the Government of Canada's Working Group on Productivity in the Public Sector, its Advisory Council on Interprovincial Trade, Bank of Canada's External Review Panel on its Pandemic Response, and the provincial Alberta Next panel. His research appears in leading academic journals, and you often see his commentary on public policy in the media. Trevor returns to GRI's macro series for his third year in a row with his take on November's federal budget, Canada's lagging productivity, rising deficits, and government effort to stimulate growth. While the Canadian economy has proven to be rather resilient in the face of major disruptions, it is still early and things could go sideways as economic challenges build. The speeches at the World Economic Forum in Davos were not quite reassuring for the global economy. Nonetheless, Budget 2025 has presented a blueprint of Canada's economic priorities and how this government plans to deal with economic headwinds. Trevor, welcome. We are excited to hear your presentation. Over to you.
Great, thank you. And thank you for everyone for taking the time this morning to dive into some of Canada's productivity and fiscal challenges. So I'll take the first 30 minutes or so to lay out kind of the current landscape that we find ourselves in, both the short-term challenges that Canada's economy has been facing over the past year and is likely to continue facing to at least some degree over this coming year and beyond. But much of what I'll speak to really concerns longer-term, larger economic and fiscal challenges related to lagging productivity growth and some of the mounting fiscal pressures, both federally and provincially, that, as noted in the intro, does complement what some previous speakers have spoken about. Now, the two challenges, longer term, economic and fiscal, are related in really important ways. And I think understanding some of the kind of underlying pressures that governments are grappling with will help leaders of any organization better navigate what is going to be, I think, a fairly interesting next couple of decades, as both of these challenges, productivity and fiscal, are not going to quickly be solved. Now, any discussion of longer-term challenges, of course, especially today, needs to begin by looking at what we're facing now. What are the priorities for Canadians? What are the priorities for governments? And what are some of the difficult waters that businesses and other organizations are navigating? And of course, much of that was really sparked early last year with a dramatic change in U.S. trade policy. This, of course, is not new here, but I think it's worth re-emphasizing the dramatic potential scale of the change in U.S. trade policy. In early April, following Liberation Day, had all of the tariffs that the U.S. federal government announced would have been implemented, then the average tariff on all U.S. imports would have been somewhere around 30%. There are different ways of calculating this, and so different sources will have different numbers, but I think this is my preferred estimate. And it's a level of tariffs that the U.S. has not seen since the 19th century. And it's a dramatic change relative to anything we've seen, even higher than the peak of tariffs enacted during the Great Depression with the Smoot-Hawley tariffs. And unlike trade in the past, today's highly integrated global economic environment means that these tariffs are much more disruptive than they would have been in the past, where trade was really much more about specializing in one item and exporting that in order to import another. These tariff changes really do disrupt the very way in which we produce most goods and services, as a majority of global trade crosses at least two borders before it ends up actually in the hands of a final consumer. But of course, the US did back down from a lot of those announced changes, but even as of about 3 weeks ago, the average tariff rate is still at a level higher than any point since the Second World War. And so we have still now experienced a fairly large shock in terms of trade. This matters, of course, for Canada, with such a large fraction of our overall economy tied up into exports to the United States. There's some advantages to that, of course. It's a large market. We are richer as a result of our access to it. But that does mean that changes in US trade policy can be a fairly significant disruptor to Canada's economy. Roughly 12% or so of overall employment, or 13% in Ontario, 14% here where I'm from in Alberta, of all jobs are embodied in exports to the United States. And this includes not just jobs in employers that are direct exporters to the US, but this also includes the jobs up the supply chain that produce inputs in order to facilitate those exports. And our share of income even larger. 14 cents of every dollar earned by workers, businesses, governments right across the board in Ontario comes from exports to the US. Alberta is much higher at 29%, and mainly because of oil exports being such a high value item that's principally shipped to the United States. But right across the Canadian economy, a really significant share of all income comes from exports to the United States. And so the tariff changes that we've seen are, of course, going to be something that lowers demand by US consumers for Canadian-made items. That lower demand is going to translate into higher unemployment and lower GDP growth, lower income growth. Bank of Canada recently estimated that the tariff shocks that we have incurred so far, like the actual implemented ones, have shrunk Canada's economy, roughly speaking, by about 1.5%. That's pretty significant. Not quite enough to have caused a recession, as many, myself included, were concerned about in early 25, but a pretty significant shock nonetheless. We are lucky, though, so there is some bright side to this. Some of the biggest tariff changes enacted by the United States are targeting other countries. Here we're looking at a map of average tariffs by the US against imports from every country in the world, and the darker the red, the higher the tariff. And Canada is lucky in that our average tariff does not exceed, at least currently, 5% overall. Whereas in Europe, depending on the country, because the composition of exports are a little different country by country, it's averaging in excess of 10% for most of that country. And of course, China's really off the charts in terms of their average tariff rates. But relative to other countries, Canada's in a fairly good position in terms of the average tariff that is levied. But, and this is a very important but, the tariffs that the US does levy on imports from Canada can be quite large for some products. Very high in steel and aluminum, for example, high in autos. There are, of course, the longer standing softwood lumber tariffs and so on. And the level of trade restrictiveness is actually much higher than the average tariff suggests because of those extremely high rates on some products. And without going into too much details, the distortionary effect economically of a tariff increases at an accelerating pace. It increases with the square of the tariff rate. And so going from 5 to 10 is one thing, then going from 10 to 15 or 10 to 20 is a much, much higher cost on the economy overall. So the trade restrictiveness of US trade policy with respect to Canada is roughly triple what the average tariff rate would suggest. And so there is some challenges here despite the low average tariff. And it also means that the geographic effect of these tariffs is very different from one part of the country to another. The average tariff on exports from Ontario, 8% now, whereas it's only 0.2% in Alberta, or 0.1% for Newfoundland and Labrador. And so this is a unique kind of challenge for the government of Canada to navigate, because federal policy, national policy, it is hard to adapt to local circumstances. It's not impossible, of course, but it does require a lot more flexibility and nuance to federal policy than we have seen in recent years, just because the shock that different provinces are experiencing is so dramatically different, because different sectors are hit by different tariff levels. Now, finally, before I turn to the long-run challenges, perhaps the greatest short-run challenge for many businesses in particular is the very high level of uncertainty that we saw through 2025. It's come down quite a bit, and there are different measures of uncertainty, but this is my preferred measure. It's also one that was featured in the Government of Canada's budget of 2 months ago. By the end of the year, the level of uncertainty has come down from its peak, which was extremely high early in 2025. But notice that while an improvement, we are still at a level of uncertainty that dwarfs anything we have seen, with the exception of COVID. We are now at the level of uncertainty that, with the exception of COVID, is somewhat equal to the period in the first Trump administration when NAFTA was being renegotiated. So uncertainty is high, and that means investment will be lower than it otherwise would be. That also means hiring will be lower than it otherwise would be. And that's really the biggest source of slowdown in Canada's economy, just the uncertainty. But as challenging as the recent period has been, the past 12 months for Canada's economy, there's a much larger challenge that is receiving increasing amounts of attention, and rightly so. And I say larger for the simple reason that lagging productivity growth over now several years has amounted to a reduction in the size of Canada's economy that is an order of magnitude larger than anything a trade war with the United States could have generated. And productivity matters. Let me just ground us here, and perhaps for this audience, unlike some others, doesn't need to be convinced that productivity matters, but productivity drives real income growth. The affordability challenge that concerns many Canadians is, at the end of the day, really a productivity growth challenge. Incomes are not growing as much faster compared to prices than we would like. And indeed, over the past decade, the pace of real income growth per person in Canada is the third slowest decade ever. I should say in recorded history. So in the past century, we don't really have excellent data prior to the 1920s, but the Great Depression was worse, not surprisingly. And the 1990 recession, a very deep and long-lasting recession in Canada, that was worse. So we're in a moment now where, over the decade between 2014 and 2024, real income growths, have grown slower than any other period, with those two exceptions. It is as though we're in a recession, but not in one. And it's not just because of high inflation. Notice in the 1970s and early 1980s, inflation was high, yet real disposable income growth was substantially higher than what we see today. And this is because of the productivity slowdown. There's lots of ways to visualize this. And this is a graph that others have shown. I do kind of like it because it really starkly illustrates the scale of the challenge. For 20 years, between 1995 and 2015, Canada's economy rose and fell along with the US. So here we're looking at real GDP per capita from the beginning of 95 through to the third quarter of last year. But over the past decade, we've seen a slowdown in the pace of real GDP per capita growth in Canada. It's increased by about 2% over that entire decade. But for the 20 years prior to 2015, it would on average grow by roughly 1.5% per year for 20 years on average. Meanwhile, the US has continued its normal pace of growth. And I like this comparison, for the simple fact that Canada's economy, so much of it is tied into the US, that when the US rises or falls, we tend to rise or fall with it. And so it is unusual to see this kind of divergence between us and them. And the scale of that divergence, it's compounded over time such that had Canada simply continued the pattern that prevailed for the 20 prior years, our economy today would be about 18% larger, or $600 billion a year. And estimates of a trade war with the United States, Bank of Canada's estimates, my own put out by the Canadian Chamber of Commerce, suggested about 2.5% reduction in Canada's economy would result from a full-blown trade war with 25% tariffs being levied by both sides on nearly everything. And so this productivity slowdown is an economic cost that is vastly more significant than trade disruptions with the United States. It's easier to ignore in that it's slower moving, and it's only now that the government has turned its attention squarely towards it, and kind of rightly so. But the challenge is significant. One way to see how significant is to look historically, right from Canada's beginning, at our GDP per capita relative to the US. It's always less than the US, and Canada does have some fundamental challenges that kind of detract from productivity, the vast geography and smaller populations, smaller market. These are challenges. Our more decentralized country creates internal frictions that are also a drag on productivity. So it's not unusual for us to have lower income than the US, but it is unusual for us to have as large a gap as we do now. Notice in 2025, the tail end of this red line, we're at about 70% of the US level, which means they're producing on average per person about 45% more than Canada. Normally, the post-World War II experience is that we're at about 80 to 85% of the US level. So we have not, since the Second World War, seen a gap between us and the United States as large as it is now. And I'll return to this figure in a bit to kind of ground us into thinking about how long this challenge will remain. I'll just quickly note that different provinces are experiencing this in different ways. Alberta and Saskatchewan, because of oil and gas, do have higher average GDP per capita than elsewhere, but even Alberta, Canada's highest income province on average, is 20th when compared to all US states, and Saskatchewan 25th. Most provinces are 45th or below. Now, you don't need to compare to the United States to see that there's a problem over the past decade. And here it just goes to the second quarter of 25. Comparable data has a little bit of a lag for these countries. Relative to the entire OECD, our 2% growth over the past decade compares to the OECD average of advanced industrial economies of 15. So yeah, the US is outperforming many other countries, but we have a problem even compared to the OECD average. Indeed, in 2024, it was the first time that Canada's economy fell below the OECD average. So Canada's economy right now, on average, is weaker than the typical advanced industrial economy. And we haven't seen that, at least in the past half century when comparable data really started. And so this is a real problem that the government has kind of squarely aimed at trying to address. There's lots of options, and I'm not going to dive into the details of all of these options here. I think for this topic, this audience really thinking about risk and uncertainty. Part of the risk and uncertainty that we need to navigate is recognizing that the slowdown in productivity is going to lead to potentially big policy changes. Well, I should say, hopefully, will lead to some big policy changes to try and move the needle. And that does complicate long-term planning horizons because it creates policy uncertainty. Rules of the game changing creates risks for businesses as well. And so I think we need to think about governments responding to the big problem. They'll do so with regulatory reform, tax reform. We've seen big moves last year on internal trade, potentially some changes in many sectors on increasing the amount of competition. So there may be some incumbent firms in sectors where entry costs are artificially high because of government policy that might see changes there, increasing the amount of competition that they face. Of course, that's a challenge for those incumbent firms, but there are some longer-term economic benefits for Canada's economy as a whole. Infrastructure, labor market changes. I'll turn to fiscal policy in a moment, but that's going to be an area where some challenges arise. And so tax changes, spending changes, this is also at risk for businesses and Canadians to keep in mind and navigate. And when I say risk in this sense, I don't mean that in a negative way. I think there are some necessary changes, but it does create some challenges to navigate. Big changes that we've seen provincially, just a couple of months ago on internal trade, a mutual recognition agreement. This is something that is now in force that for goods producers outside of food and alcohol really changes the game. It effectively means subject to some exceptions and so on. And so time will tell how impactful this is for productivity growth. But provinces effectively agreed to defer to each other's regulations. If a good is deemed safe for sale in one province, it is automatically good to go in another. Again, subject to exceptions. So seeing how businesses navigate this kind of new internal trade environment will be very interesting to watch. And I think this is really just the beginning of many more reforms to come. The very nature of federal-provincial relations is changing. The Alberta Memorandum of Understanding received a great deal of attention, but it's worth noting that is not the only MOU. The feds have approached different provinces. Ontario, for example, also has one. And I think we're entering a period where federalism will be a lot more flexible than it has been in the past, where federal policy might apply differently in different parts of the country. In part, I think this is a natural and appropriate response to provinces facing very different circumstances, but that does create some challenges for businesses to both keep up with those policy changes and navigate them. Before turning to fiscal policy, I'll just note finally one last critically important point on productivity, and that's governments will be facing and trying to tackle this challenge for decades to come if they actually want to solve it. In order to return to where we were 10 years ago, in terms of our relative position to the US, assuming the US continues on a normal pace of growth, it would take roughly until 2050 under a fairly optimistic scenario in order for us to dig ourselves out of the productivity hole that we're in. Now, why do I pick 0.7% faster productivity growth in this graph? Well, in Budget 2025, the government laid out a number of measures aiming at trying to boost investment. And in that budget, the government itself characterizes kind of an optimistic scenario where if everything works out as they hope, then they will boost growth over 5 years by about 3.5% or 0.7% per year. And so this is if the government's optimistic projection does come about and they continue it for another 2 decades after that, then we'll be back where we were in 2014, but it'll take all the way until 2050 to do it. So the slowdown in productivity growth is now a generational challenge for us to solve. And it's going to be a bumpy road getting from here to there. And that is something that we must all, I believe, keep in mind. And the last few minutes here, I want to turn to fiscal policy. This is something that previous presentations have talked about with respect to debt sustainability and issues there. I do want to note how I think about the scale of the challenge, and I think this is a little bit differently than some of the commentary by others. And I do want to link this to productivity and then some of the unique challenges that some particular provinces, time permitting, face. Federally, the fiscal challenges that we face are really hard to understate. A reference was made to the 1990s, and then the challenge really was the high stock of debt and the incredibly high interest burden of that debt, accounting for about 1/3 of overall federal revenues being required to cover interest on the federal debt. So we're not in that position, not at all. But we face a similarly significant challenge federally, largely as a result of the upending of the global geopolitical environment and the global security environment that we and other advanced economies and in particular democracies face. NATO targets rising from the 2%, which now we meet, to 5% over the next 10 years, 1.5 points of which I think is kind of it's hard to wrap our head around what that means quite yet, around peripheral activities, infrastructure, things like this, that I suspect we will meet that target without really doing anything different. We'll just be classifying things in new ways. But core military spending, the new target for that within 10 years, so 2035, is 3.5% of GDP. That's a very large increase for Canada. And if we meet it, and because of the changing nature of the global environment we find ourselves in, we may have to meet it. And I guess I don't want to predict whether we will or not, but it was previously a lot easier to shirk on our 2% responsibility. It's going to be less easy for us to continue shirking in the way that we have in the past. But that increase from 2 to 3.5%, in order to cover that on the revenue side, we'd have to double the GST. That's the scale of the increase in spending, bringing the GST from 5% to 10%. That's what's required to cover the military spending increase. And of course, I'm not suggesting that would be the appropriate policy response. That just gives you a sense of scale. Alternatively, of course, the government could reduce spending, but the federal government largely spends money on transfers to people and provinces. And if we are to not shrink transfers to people and to provinces, and I should say subsidies also to businesses, then in order to meet the military spending goal and balance the budget in 10 years, we'd have to cut between 40 to 60%, depending on the scenario, of every other area of federal spending, including Indigenous and Northern Affairs. Right? And so that's a level of spending reduction that is just not going to happen. So there's going to be some mixture of spending changes and tax changes. And what that mixture looks like, Budget 25 didn't give us much by way of indications here. It enacted some restraint measures, and as we've seen some recent layoffs in the federal public service, these are really nibbling at the edges in terms of the scale of the fiscal challenge the federal government faces. And I should say borrowing is not an option. Or I should say it's an option, but it's not a prudent option because it would create an unsustainable debt trajectory. And I mean literally unsustainable. In blue, this is the long-term projection that I've constructed for the next 30 years for the federal net debt to GDP. This looks very similar, although independently constructed, I must emphasize, from what the federal government's own estimate is as it reported in Budget 2025. And so that trajectory, roughly for the next decade and a half, has a largely flat net debt to GDP trajectory before declining later on. But that baseline projection and what was in the government's own projection 2 months ago does not include the military spending. If you were to include it, as of course I think responsibly we ought to, because we have committed to that target, then you get the red line. A continually rising net debt to GDP ratio over the entire projection horizon. That's not sustainable, right? It would lead us to net debt levels in excess of what we saw in the middle of the 1990s by the end of the next decade. So something we'll have to give. But this is where I'm going to link to productivity. Productivity growth, increasing the size of the economy, that increases government tax revenue. Income taxes, consumption taxes go up when GDP goes up, when incomes are higher, when business performance is stronger, naturally. How large would the productivity growth need to be in order to overcome this fiscal challenge? Well, a 0.5% faster productivity growth, that's roughly speaking the minimum of what you need. We'd still see a rising net debt out to about 2040, but then it would decline. A 1% productivity growth rate, though, is required to keep stable net debt to GDP over the next little while before declining thereafter. So that's kind of the scale of the increase in productivity growth that we would need to address the fiscal challenges. And whether we do or not, whether we succeed in moving the needle on productivity growth or not, It'll take a while to know the government's clearly focused on it, but it aiming to boost by that 0.7 that I mentioned earlier, not only gets us on a trajectory that maybe converges back to the US, but also is a very important driver of addressing this fiscal challenge. And the risk is that we don't succeed in moving the needle on productivity, and fiscal challenges will simply mount. Finally, and I just have 2 minutes here before I'll conclude, I'll note that provinces too have their own fiscal challenges, and nothing new. Aging population has been accelerating since 2010 and will continue increasing for many decades to come. The share of the population over 65 is now 1/5, and it will grow to 1/4 by the 2060s. That, of course, pressures health systems, and that is by far the largest area of provincial expenditures. And the provincial debt trajectory, these are my own projections, when incorporating the demographics and the health cost pressures, are dramatically larger than anything the federal government faces. And no province is currently ready, and few provincial governments seem willing to change how we deliver healthcare in this country. Alberta is somewhat edging towards enacting some minor changes, but despite how controversial some of its recent reforms have been, they're immaterial relative to the scale of the fiscal challenge ahead. So we're not ready for this. No province is ready for this. And the federal government, unlike in the past, is in no position to boost transfers in a material way to effectively allow provinces to avoid making tough decisions. So there's a risk there provincially, that governments don't respond with reforms to healthcare. Roughly speaking, the fiscal challenges to provinces from health is about double the scale of the military spending increase pressures for the federal government. So it's roughly 2 to 3% of GDP that the increase in health spending as a result of demographics is equal to. So that's a massive change in tax rates if provinces are just going to cover the rising spending on in that way, and a massive reduction in spending if it's going to cover it by lowering elsewhere, and because it can't borrow its way out of this challenge. That is not sustainable. Something would have to give very soon. Now, I have spoken for 30 minutes. I think I'll end it here. I'll spare everyone some commentary about Alberta, but we face some unique fiscal challenges here, as the province is more exposed than it has ever been to oil price moves. It's about 5 times more sensitive to oil price changes now than it was 10 years ago. And we're going to see a budget in this province in about 4 weeks. And it'll be a very interesting one to watch. But maybe that's a conversation for another day. So I'll conclude here just by noting that these long-term productivity and investment challenges are quite significant. The ability of governments to tackle them, we do have options, but the short-term challenges from trade tensions and other things are, I don't want to say a distraction. Of course, governments should respond to them, but it's delaying perhaps how we tackle these longer-term challenges. But it does seem as though politically, the appetite on the part of the public for policy changes for a little bit of risk-taking is higher than I've seen in recent memory. And so that's, I think, maybe an optimistic note that I'll end on, and then toss it back and look forward to the Q&A. Thank you.
Wonderful. Thank you, Trevor, for your excellent presentation, and a bit sobering, I guess, with the discussion around the relatively weak productivity growth, the demographic challenges that we're facing, and the fiscal challenges that are heading our way. Ladies and gentlemen, as we now move to the Q&A component of today's event, a reminder just to please submit your questions through Slido. And again, if Slido isn't accessible to you, I will also check the WebEx chat. So I'll ask a question. There was a very interesting article in the Wall Street Journal yesterday, and the headline was "The World Economy is on Debt," and suggesting that governments are borrowing and spending at unprecedented levels for short-term economic growth, but sort of kicking the can down the road because there will be major consequences by taking on this level of debt. So the question is, for Canada, with these massive new planned expenditures, is there sufficient evidence then to show that this level of capital spending truly raises productivity. And I think in your presentation, your emphasis really was that productivity growth is what's going to get us out of this hole. Do we have sufficient evidence then that this level of capital expenditure is going to increase productivity and help us in our overall fiscal picture, or is it just going to increase the debt burden, passing it on to the next generation, and all the challenges that will come from that?
Yeah, that's a really great question, and lots of things that I'll comment on in response. So first, there's different notions of productivity, different measures of it. What's relevant for GDP per capita for average incomes is what's called labor productivity, kind of the amount of goods and services we're producing per hour worked effectively. Most labor productivity growth, and I mean the overwhelming majority of productivity growth, comes from what's called capital deepening. This is an increase in the amount of machinery, equipment, technology, and so on that workers are able to use to enhance the value of their work. And if you look at the past couple of years, business investment has, not just had slow growth, but has been declining. 2 out of 3 quarters, roughly, was negative in terms of business investment change quarter over quarter in Canada. And so that's a real challenge. So no evidence yet that capital and business investment levels are rising. Part of that is uncertainty, of course, is going to be detracting from that, and other challenges too. The government's goal is, of course, to boost investment. Very ambitious goals to do so. But what we saw in the budget was very limited in terms of policy changes that would actually move the needle there. The biggest one is perhaps their tax change by allowing for immediate expensing of capital investment by firms on selected types of investment. And it's a big benefit to manufacturing, a sector that faces unique challenges with autos in particular with respect to the United States. So time will tell whether we see those measures yield the benefits in terms of increased investment that the government would like. In general, there is strong evidence that these type of tax changes do boost investment. So there's various empirical research studies on this in various countries. And so it's a policy tool that has strong evidence behind it. Whether it has that effect today, we'll have to wait and see. Finally, on the government characterizing the increase in its capital investment, I think it's more of a communications approach that the government has taken rather than a real change in fiscal policy. The government is now separating what it calls operating spending from capital spending, and they do not mean what we usually mean by investment in an accounting sense. They treat as investment, for example, subsidies to wages and salaries paid in the film and television industry as an investment, right? So it's just a pure communications game in order to, quote, balance the operating budget over some relatively short time horizon. But it is not actually about increasing real capital. And so I completely dismiss the federal government's framing of the budget and distinction between operating and capital because it deviates from what really is capital.
Very good. Thank you. I do have a follow-up question on the tax incentives, but before that, let me just pick a couple of questions from the audience. If you could please comment on the impact of both immigration and artificial intelligence on potentially lifting productivity. What changes potentially have to be made to our immigration policies, and then have you discounted artificial intelligence as that thing that is going to really boost productivity in the future?
Great question. So on immigration, whether immigration flows add to or detract from aggregate average measures of GDP per capita or labor productivity depends. So many have pointed to the spike in immigration inflows in the past couple of years as a potential cause of the decline in GDP per capita, and therefore will quickly reverse itself now that immigration policy has changed. I think that's an optimistic view, although there might be something there. But if you look into the past, pre-World War I, the greatest period of economic convergence between Canada and the United States, some recent research by economists Vincent Galloso, and Casey Pender recently published, actually through the University of Calgary School of Public Policy here about a month or two ago, really documents how immigration added to our productivity growth then, because the composition of inflows was such that there was strong alignment between those coming in and what was needed in the economy to boost activity. And I think that's where maybe there were some challenges with recent immigration policy. There was an effective abandonment of the point system. We stopped selecting largely for economic outcomes when we were looking at immigration inflows into Canada. And so that, I think, was the biggest potential contributor to the slowdown, at least in terms of immigration. But the slowdown in productivity predates the change in immigration policy by many, many years. That is not the cause of this slowdown that has mounted over the past 10 years by any stretch. Going forward, in terms of whether immigration can help, that would rely on us returning to a system that selects for skill. A really strong return to the point system, for example, where the type of immigration inflow is one that brings up average labor productivity in the country, where skills are very much aligned with needs within the economy at the high end. AI, though, this is interesting, and I have no expertise in what might be in store for that technology, but there are certainly optimistic views that will be a real accelerator of productivity growth in the years to come. And hopefully, indeed, it is. That would lead to increases in living standards, and that would be fantastic. And that would really help address the fiscal challenges we face, but also, just good for its own sake, boosting living standards. It may take time for us to see that, just like internet penetration, computerization that we saw late 80s, early 90s. It took a long time for that to really start to mount and boost productivity growth through the mid to late 1990s. I think there's a Greenspan quote that's quite famous now that I'm probably going to butcher, but I'm paraphrasing roughly accurately, that we see the effect of computers everywhere except the productivity statistics. And so we may very well have a period where we see that with AI. And the reason is, there's a period where you're investing a great deal. You're deploying resources into AI and trying it out in different ways. Some ways are not going to work. So there's going to be a lot of learning as we try and implement AI in different ways, in different places. And eventually, in the optimistic scenario, we'll figure out where its best uses are. But that alone won't help our convergence with the US. If anything, it may increase the gap. Canada tends to lag behind others, the US in particular, in our adoption of new technology. And so if AI truly is an accelerator of productivity growth, the US is probably going to experience it first, increasing that gap further. Now, we can change that by making it easier to adopt technologies through some tax changes, or increases in competition is also a way to spur firms to try out new things. Otherwise, they'll be displaced by new entrants. So time will tell. And I personally have no view either way, other than I hope that indeed we do see an acceleration of productivity from this new technology.
Very good. Thank you. In one of your slides, you mentioned uncertainty as being one of the biggest instruments to having for businesses to invest. The government is assuming that the productivity super deduction and various investment tax credits will unlock hundreds of billions of private capital, essentially crowding in private investment as a way to boost the economy and improve productivity. Bank of Canada's own business survey indicated businesses are planning to cut costs, and you did mention this in terms of either reducing hiring or even outright reducing their headcount. And on the investments, apparently businesses are more focused on making investments in routine maintenance rather than actually acquiring capital, expanding the business. So, which goes back to your point, that uncertainty in this environment, there isn't what we're hoping for, to have these massive levels of private capital being invested in business. That may or may not happen.
Yeah.
Yeah,
I
I'm just wondering what your thoughts on that.
Yeah, I think about that a little bit differently. So first, no question, uncertainty is a drag on uncertainty. The measure of uncertainty I showed spiking in March of 2025 to roughly triple the level we saw briefly. And then the worst point of the pandemic, for example, there's a great deal of empirical research across many countries, but Canada included, that looks at these measures of uncertainty and connects them to business investment, to hiring, indeed even to stock market performance of firms that are in particularly uncertain circumstances or sectors are exposed to those changes. And so uncertainty, no question, matters. And if historical relationships hold, then the scale of uncertainty spike that we saw in early 2025 would normally be associated with a 25% drop in business investment and a 1 full percentage point increase in the unemployment rate. Now, we've come down a lot since then, and that's good. But perhaps roughly as much as half of the rise in unemployment that we saw might have been due to uncertainty and a slowdown in the pace of hiring and job vacancy postings and so on. So uncertainty is very real. And so that's important to note. And to the extent that it continues, that'll be a big drag on growth in the short term because investment in hiring slows prudently. But that doesn't mean the tax change will not have an effect. We need to think about a counterfactual Canadian economy that we cannot observe, but would represent a world where we did not enact the tax change and yet still faced the uncertainty we do. Would investment be even lower than it is now with the tax change and the uncertainty? And the evidence is quite clear. It is hard, of course, to prove these kind of counterfactual effects of a policy. Empirical researchers definitely have their work cut out for them, but lots of different papers in different settings with different methods. And the underlying theory that, of course, incentives matter. And so increasing the after-tax rate of return on investment should increase investment levels, suggests that these tax changes, like the government is, I'm not going to use the name they chose to use it, the acceleration of the capital cost allowances for different types of investment, that has a real effect. The marginal effective tax rate on investment was about 15.5%, and that's fallen to nearly 13. So that change alone, it's as though it's a 2.5 percentage point reduction in the tax on new investment. For manufacturing, the marginal effective tax rate fell by a little over 8 percentage points, nearly reaching 0. That's a big effect. And there will certainly be businesses that respond to that. But that does not imply we're going to see an investment boom because there are other things going on at the same time. But we shouldn't then conclude that the tax change was not worthwhile. Indeed, I'm of the view that we should be thinking about expanding and making permanent that tax change because right now it is highly targeted and temporary. And so the economic effect of it is going to be limited because of that. The sector that has perhaps the largest slowdown in productivity, indeed it's fallen in productivity, is construction. And it's still right now, even with the accelerated capital cost allowance from the budget, is going to face a 21% effective tax on investment. And so there are big taxes that we levy on investment, and that absolutely lowers the incentive to undertake those investments, and that absolutely, because incentives matter, will detract from overall investment levels in the country.
Thank you. Bit of a broad question then. Given all the challenges that we face, and in particular the demographic challenges, for example, we've got what is essentially becoming an inverted demographic pyramid now. Instead of having a larger base, now we've got a bulge in the middle, and then if the current rate, it's entirely possible that we will be seeing a full inversion of demographic pyramid, which then has all sorts of implications for fiscal policy, taxation, how we can support the programs if there just aren't enough workers. So in terms of prudent fiscal policy then, is, in your view, fiscal policy becoming just too expansionary for a slow growth and high rate environment? Real GDP projected somewhere around 1% in the near term, borrowing costs are structurally higher. All of these will have long-term implications. Are we now basically in a cycle where fiscal policy, we have no choice but to engage in expansionary fiscal policy?
So I would not agree that we have no choice but to engage in expansionary fiscal policy. There's certainly, and I'll concede a generic point, that there is an interesting debate on the effectiveness of fiscal policy to combat short-term slowdown in economic activity. So during recessions, it is not unusual for governments of all political parties to increase spending and cut taxes to try and stimulate activity. How big of an effect that is characterized through what's called the fiscal policy multiplier. For every dollar of fiscal policy expansion, spending or tax cuts, how much does that change GDP? And there's not a clear answer to that question. I'd say that one can point to some really excellent research suggesting it's not zero, but then other excellent research suggesting that for small open economies, it might be zero. We may very well see, and there's different mechanisms that drive this, an increase in government fiscal policy in Canada increases the value of the Canadian dollar, which decreases exports in a way that kind of crowds out fully the effect of what the fiscal policy expansion is on GDP. So I'd say it depends. If I were to bet, I'd probably say fiscal policy on balance is positive but small. And so we should be thinking about using fiscal policy in a way that achieves long-term goals rather than using it as a way to address short-term challenges. But I will note quite openly that others would disagree with me on that. Long-term, though, fiscal policy, the increase in the amount of spending is being driven by these exogenous forces. So governments will expand in scale because of healthcare costs rising. It's 40% now of provincial government spending overall. It'll soon rise to 50 over the next couple of decades. And if we look federally, it's not as exposed to demographics as provinces are, but benefits to elderly individuals by the end of the budget time horizon is projected to reach $100 billion. We will be transferring nearly as much to elderly individuals through things like old age security as we do now to provinces through health, social, equalization, all the Fed-Prov transfers. We can slow the growth of transfers by tightening up the income eligibility rules, by increasing the age of eligibility for old age security. We were set to increase it to 67 back in 2014. A really politically difficult move, but one very much focused on addressing a long-term challenge that was reversed. And I think that should be back on the table. Ways of gradually changing the trajectory of spending growth can really go a really long way helping the federal government manage its finances for the long term. There is no avoiding slowing the pace of growth of transfers, though, if we're not going to entertain dramatic reductions in federal spending elsewhere. And I mean completely infeasibly large reductions in spending elsewhere or large tax increases. So we should be tightening up old age security. And we should be changing transfers to provinces. As we did in the 1990s, that's, it's a big area of federal spending. We can slow the pace of growth of those transfers. We have various transfers conditional now on provinces achieving things, on health agreements, on community building funds, on early learning and childcare, lots of conditional transfers that we could bundle into a block grant where provinces have more flexibility to do what they want. But in exchange, there's going to be fewer dollars in the future. And that is another way for the federal government to achieve its longer term goals. So the feds have a lot of options. And it should be making its fiscal policy, in my view, if it wants to focus on risk and de-risking our longer term fiscal future, it should really be focusing on that longer term fiscal challenge. And that means having a fiscal anchor that it sticks to. It means ensuring that debt to GDP does not rise. And the abandonment of the fiscal anchors in the last budget, to the extent that those fiscal anchors were fairly weak already, but just abandoning them completely was somewhat imprudent in my view. And so it'll be interesting to see what the feds do in this coming year.
Very good. Thank you. Ladies and gentlemen, we are approaching time. And before we get to our final question, a very short survey is going to be up on your screens. Just a reminder to please take a moment to rate the event. Again, just our rating, no comments required. So for the final question, I'm going to turn to the audience on this one. Given Canada's productivity challenge, maybe less about capital scarcity than investability, what role can institutional investors play? What reforms are needed to attract both domestic and global long-term capital with fiduciary constraints?
Large investors, whether it's pension funds or hedge funds or other large players, they will be allocating their capital in a way to achieve their financial goals, to maximize returns. And so I'm personally of the view that the solution to increasing investment in Canada, or the solution to our lagging investment in Canada is not to somehow force or require institutional investors to invest in Canada. And some have proposed that, especially with respect to regulations on pension funds. Right? We should ask why they're not investing in Canada. First, they're investing a lot, but what might be holding back decisions to invest more? Well, that for me just comes down purely to incentives. What is the return on investments? And many institutional investors, the tax rate implications may not be as relevant because there may be investors that are tax-free, CPP, for example. But there, the return is going to come from the underlying economics of the project. And the returns there are going to be held back to the extent that some projects are more difficult than others to get off the ground or execute upon, and to the extent that there's regulatory burdens or other things that detract from the underlying economics of these projects. Removing them is a way to boost investment. And that is exactly what the government is trying to achieve with things like its major project office, with removing certain federal regulations and certain types of projects. And I think in the short term, that may be an approach to move the needle by making projects more investable, by removing the burdens on them that have mounted in recent years. And that's good. But broadening that to cover the entire economy and not just the favored large projects would be a way to ensure that going forward, we can continue to improve the investability of Canada's economy. So I don't think there's a role to play specifically for institutional investors themselves. They will be appropriately responding to the fundamental economics in Canada relative to other markets that they can move into. And our focus as policymakers should be to improve that economic environment, and then investors will respond to that improvement.
So as we approach the end of this webinar, we've mentioned many challenges that the country faces now. And I think maybe we can try and leave on a bit of a positive note. And a question again from the audience: are there any bright lights, positives that you can highlight, given that we've discussed many of the challenges that we face?
Absolutely. And that's a great way to conclude. As large as the fiscal challenges are in Canada, many other countries have even larger challenges. For example, pensions is a real challenge for most advanced industrial economies. We're not the only country that is aging. And look at the disruptions that are occurring in France as it tries to tackle some necessary reforms there, like some really intense social disruptions as a result of what are difficult reforms. In the United States, the Social Security Trust Fund potentially going entirely depleted in 2033. That is not far off. And so the Canada Pension Plan being entirely sustainable over extremely long projection horizons is a real credit to some changes that we made in the late 1990s. And so while we are certainly exposed through healthcare and through old age security, we're in a much better position than many other countries. And that doesn't mean addressing our fiscal challenges do not require dramatic short-term fiscal adjustments. They just require sustained discipline through gradual fiscal policy changes that affect the trajectory of growth rather than large-scale immediate reductions in, say, federal spending as we saw in the 1990s. And provincially, we can address the provincial long-term fiscal challenges really just through two things: ensuring that provincial revenues grow with GDP which is easier said than done because only half of provincial revenues come from taxes. But small changes year by year, keeping revenue as a share of GDP constant, and reforming healthcare such that we can slow the pace of growth of healthcare by roughly 1 percentage point, which is big. But if we can sustain that, then those two things combined addresses the provincial challenge. So we have lots of options, none of which requires dramatic short-term adjustments, but we do require a longer-term focus and discipline. And I think that is an optimistic note to end on.
Wonderful. Thank you so much. Ladies and gentlemen, that's all the time we have for questions today. Trevor, thank you for joining us and sharing your valuable insights. Before we